Welcome to Multiple Perspectives. I'm David Lofgren. This episode, I'm joined by my colleague, EquityMultiple's Director of Finance and Operations, Clay McMickens. Clay, welcome to the podcast.
Thanks for having me, David.
You're here to share a conversation that you had with a former colleague of yours, David Bitner. David is the head of capital markets research at Cushman Wakefield, which is one of the largest real estate services firms in the world. But can you set up the conversation for us a little bit more? Tell me what David does at Cushman Wakefield and why you wanted to sit down with him.
David joined Cushman Wakefield about 2 years after me as head of capital markets research, overseeing our work product as a research team. He sort of led thought leadership content, put together sort of market presentations for the brokerage teams at the high level, at the national level, while I did it at more of the local level. He organized the surveys that we sent to all of our brokers and our investors, put together forecasts, and is really just a guy who understands investments and finance. I think he is probably one of the leading thought leaders in the real estate capital market space. So, I thought it was a natural fit to bring him onto the podcast.
Why talk to David now? What is it that you were trying to understand when you were sitting down with him?
Right now, there's a lot of lack of understanding on what's going on in the market currently and what's going to happen in the future. And the beauty of David's job is not only that he has a great grasp of all the details, is he has access to all of the information needed to make these forecasts. He works with the best brokers across the country, has access to the best databases in the country. So sort of interesting that, he has a longer term view at the market, which, I think sometimes investors and even me at my job sort of get bogged down in just sort of near-term dynamics. So it's nice to sort of have a conversation with someone who sort of says it's important to step back and think about it, not just over the next month or year, but over the next 4 years and longer.
Yeah, it'll be interesting to see what he has to say with his broad view of the market. Well, let's jump into this then. Thanks again for doing this, and maybe I'll check in back with you after we listen to the conversation.
Great. Yeah, that'd be awesome. Thanks for joining, David.
Thank you for having me. It's a pleasure to be with you virtually.
Yeah, of course. Yeah, as everything's happening now, it's all virtual. We spent a lot of time surveying and talking to our clients to get a feel for how they're viewing the market. And I think, even pre-coronavirus, I think there was this sense that we were nearing the tail end of the cycle. And obviously, when coronavirus hit, it really sort of accelerated that. What's your opinion on this? Where do you think we were in the cycle pre-COVID, and where do you kind of see us now?
Well, I think that, right up until the eve of the current crisis, we were in I would describe it as a mature cycle. Late cycle presupposes the ending. I don't think that we can go back and look at where we were in January and say the seeds of destruction were there.
Yeah.
I certainly didn't see them. I woke up every day trying to find the catalyst, and it ended up being none of the things I thought it could be.
Well, this is normally the case, right?
Right. We talk about the financial crisis as though it was a black swan. That's where the phrase became very popular. It was not a black swan. You can go back in the data and see it. It was there. Mm-hmm. In fact, I worked for Mike Burry's right-hand guy, who was literally pouring through CMBS docs and being like, "This is all screwed up."
Yeah, and Mike Burry was the doctor made famous by The Big Short, correct?
Exactly. Played by Christian Bale.
Yes.
Yeah, so that was my boss. That was the guy who was the global investment strategist that I was the right hand to. So there were people that saw it.
Totally.
And it was to be seen. It was not truly a black swan. It's just a surprise to most of us. What we're having right now is a true black swan, coming out of nowhere, pounded in the back of the head.
Yeah.
We were in a mature cycle, which the way that I would simplify that is that you have some markets that are slowing, you have some markets that are accelerating, you have a steady stream of jobs, But you're not looking at it and saying like, wow, we have a ton of untapped capacity in the economy. We didn't have any real issues with inflation. People were constantly looking at asset valuations and thinking they're pretty fully valued. But there was a lot of oscillation around that point and a general uptrend, as revenues continued to grow. So I think it was a very difficult investing environment. And that's certainly the impression you got talking to just about anybody in the industry.
Yeah.
You're in a world where assets are fairly valued for the most part. And there's a ton of capital chasing every asset.
Yeah, and all the deals are not really deals once you have all that capital going after the same product.
Yeah, exactly. So we saw, a few years in a row where their, return targets were, gradually coming down. And frankly, institutional investors were aware of that. And they'd be like, okay, I get it.
Yeah.
And so it was, for us, it was fantastic. We had year after year of incredible transaction volumes. But it was a tough one for our investors. But, I go back to 2017 and my big theory at that time, I was like, okay, there's all this money. We're going to see institutions in particular just get more and more aggressive because they're going to face that cash burn pressure. And, I was right, maybe 20%, so to speak. They were very disciplined. Very, very disciplined.
Yeah.
Very, real living historical memory of what happened in 2007 to 2010.
That all makes sense. So jumping into another topic, part of it, along with our conversations we have with investors, what we've been hearing from a lot of them is that currently, they're more interested in appreciation than near-term stable cash flow. Is this something you're seeing in the broader market? And what are your thoughts on sort of what investors should be targeting and sort of optimal investment strategies people should be looking to deploy?
Getting a whole bunch of appreciation right now is predicated on the idea that there's a large pricing correction, right?
Which I don't know if has occurred yet.
Well, this certainly hasn't occurred yet. It's difficult to espy because, look, let me put it this way. If you own like a good bones office building and you went out into the market and took 20% off of the pre-COVID price, there's going to be money lined up around the block to buy it from you. There are not that many sellers who are willing to take that write down at this point in time.
Got it.
So the deals that are going through, are generally showing like fairly minor adjustments to value.
Based on, maybe dips in the current cash flows, we're seeing that on our end. People who are in contract have now seen, price decrease, going back to the sellers and asking for discounts of 5 to 10%. But it's nothing major where you see these 25, 20%, going back and renegotiating contracts. It's more just, your cash flows dropped a little bit. And so we want a little bit of a discount, but not totally redoing the wholesale.
Yeah, exactly. And I've done the math on it. If we're talking about like a good building, stabilized asset, let's say it has like 12 years of WALT. Even if prevailing rents go down pretty significantly, if you're able to maintain your occupancy, and you figure you're in a monetary environment where interest rates remain low, and that holds down debt costs and could even drive them even lower than they were pre-COVID over the next year. In a lot of cases, they're not there yet.
Which is hard to imagine based on how low they were already.
Look, if the 10-year Treasury is still at 1% or below, and the markets certainly seem to think that that's the case, then you can lend money, at sub 3% and have a better spread than you used to have.
Yeah, which is pretty crazy.
And spreads are everything. That's what, that's the risk adjusted. That is the risk premium that you're being rewarded for taking risk. And, the way the market's priced right now, you either as a lender or as an equity investor, you're being handsomely rewarded. That's particularly true. And I think this is germane to the increased interest that you've told me about that you're having in your platform, it's particularly true if you compare prevailing yields, particularly, like risk-free rate adjusted yields that are available in real estate compared to corporate credit and even more so equities.
Mm-hmm. Yeah, I mean, it's very interesting to kind of project what's going to happen over the next even 6 to 12 months. But I think for our investors, they are sort of looking for passive income, or they're looking even for 5 to 10 year holds. And I think just with the instability right now, it's hard to even know what those time horizons could really bore out.
Well, and that uncertainty goes back to why, if you're a seller, you definitely didn't want to sell when the debt markets weren't functioning.
Mm-hmm.
And certainly a lot of buyers didn't want to buy either because they couldn't get the acquisition financing and didn't know when they'd be able to get it. And, might be trying to conserve cash.
Yeah.
So, and even now, I mean, we have a resurgence of uncertainty now. There's still so little visibility on, the actual dynamics that can produce, permanent changes in value, that we see most people still in this wait and see mode. There's definitely an argument for, if you have an asset and you really suspect that it's going to end up seeing some large impairments, to get out front, before the possibility becomes an undeniable reality.
Mm-hmm.
But in a lot of cases, I mean, I think we're looking at, say, the public markets. And I mean, like, I'll give you an example. I mean, I'll go look at office REITs, when they're down 25% or so, probably a little bit more now. And, you have to, it takes some pretty rough math to actually able to justify that across generally high quality, stabilized, moderate leverage, office portfolios.
Mm-hmm. So you made a comment about sort of, some debt markets tightening up. Are you sort of talking about during the Corona crisis, or was that a different period of time?
In the opening, month or two of the crisis, we saw rapid attrition of lenders' willingness to put money out.
Yeah. And have you guys seen it open back up at all, or do you feel like
it's definitely opened back up? And I think I published a couple pieces on this. You'll find on our website. But the way it went was, the non-real estate markets, the corporate debt markets, and the interbank markets needed to heal before you were liable to see any improvement in our neck of the woods.
Okay.
And that's precisely what the Fed has been able to achieve by restoring confidence through its wide varieties of facilities, as well as its conventionally unconventional quantitative easing operations. And this goes in terms of the commercial paper markets, returning to functioning. Companies stopping drawing on their revolvers, the LIBOR Fed fund spread coming back down. All of those things, are, improve liquidity through the economy. And as the most direct cognate, we've seen both high yield and investment grade corporate debt spreads come down significantly. And in fact, if you go look at investment grade debt, corporate debt, all in yield costs are actually below where they were pre-COVID. And and companies have been incredibly aggressive in taking advantage of the renewed liquidity. And we've seen more bond issuance by both, investment grade and high yield companies than, just about any time in history. I kind of said before, like, markets are all interrelated. There's, pricing is always relative. So if you're in a world where all of these tenants can raise money, it can't persist that you can't raise money for the debt on buildings that are ultimately dependent on those tenants' credit quality.
Right.
They are too deeply interrelated kinds of risk to have highly divergent pricing. So as we saw intervention from the Fed and the healing of the corporate debt markets, that all but guaranteed that we would see sympathetic action in the CRE debt markets.
Are there any lenders that are still on the sidelines, or do you feel like everyone's sort of jumped back into the game at this point?
So the CMBS market has pretty clearly reopened to properties outside of the more vulnerable retail and hospitality. So there have been a number of new issuances with very attractive executions, particularly for the lower risk tranches. We've also seen life insurance companies who are trading off between CRE lending and corporate lending, getting much more aggressive to put out allocations into CRE. Now, where the gap has continued to be the bank market, which is very large, very important. And I think that's an interesting case because it's not necessarily that they're out of money. The interbank liquidity is, like I said before, is back to normal. So that was definitely a precondition for things for that sector healing.
Right.
I think that part of it. A big part of it is that they are focusing their resources on servicing businesses, and real estate is kind of kind
on the back burner.
They're feeding last on that trough. I mean, it was very common to lay it all at the feet of PPP, but we've seen it continue, even though PPP is most of that work's already been done at this point.
Yeah.
It'll be interesting to see as the mainstream lending program comes in action, whether that sucks up bandwidth. But ultimately, I think that we're going to see the banks re-enter the market. I don't think it'll take too long for them to do it. And that's going to be because I think that the risk-adjusted returns that are offered by CRE lending are still a bit better than if you're doing it to corporates.
Interesting. So I heard you mention that sort of, retail and hospitality is still having trouble finding financing. Do you see them as sort of being permanently redlined in the CMBS market, or do you see a return to be able to finance those back to where we were a couple of years ago?
Well, permanent's a long time, right?
Yeah, of course. So maybe that was too strong of a word.
Yeah. I think that we should stay on that point. It is tempting to see a present crisis as a forever thing.
Mm-hmm.
I think that as you're investing in real estate, and not just real estate, you have to remember that eventually it will be 2024.
Mm-hmm.
And,
the world will be totally different than it is today.
Yes. Yeah. I mean, we will not be socially isolating in 2024. It seems increasingly likely that there's going to be a vaccine, in record time. And in the meantime, you're going to have more and more cases throughout the population that confer some level of population level immunity.
Mm-hmm.
And between the two of those, there is going to be a way out of the hole we're in. And I think that that's even true if you ended up, some of the worst case projections are that you have new versions of the coronavirus every year or two. They'll be able to build on the vaccine technology the way we do with influenza to the point where even then it'll ultimately become manageable. So you can open the paper every day and see somebody in the news talking about how cities are dead or, no one's ever going to travel again. To believe that, you have to believe that people's preferences have radically and permanently changed.
Yes.
And that's not credible.
No, I mean, I think there may be some long-term psychological impacts, but I don't think they'll be so drastically different than what people were thinking previously. I think that's probably a very fair assumption.
Yeah. So that kind of links back to hotels, right? If you're thinking about hotels and if you're thinking about experiential retail, and all the stuff that, was the stars of retail, they face a tremendous crisis, but a transient one with an endpoint. And so, there's going to be a ton of focus on cash flow. It's inevitable that there's going to end up being, a pretty significant distress cycle with many of these properties.
Mm-hmm.
But ultimately, for people with the risk tolerance to play, I think there's plenty of people who are going to make a lot of money on, at the end of this.
Yeah, we hope so, and we hope our investors are part of that winning group. So, turning a little bit of attention to one of the new products we launched, which is raising money for different funds. In your opinion, what's sort of the biggest benefit of fund investing versus direct investments into specific assets?
Diversification. I mean, that first and foremost. But beyond that, one way I like to think about it is like, even if your plan isn't to go and buy this massive diversified index like the S&P 500, even if you really do believe in that, it's better to have a relatively concentrated portfolio. Mm-hmm. Investing is really about having an investment process, a solid process. If you only get to go through that solid process once, like you take all the right steps, you do all the right diligence, you
check
have
off
the
all
philosophy,
the
you do all the things, right? And let's just assume that you are really smart, like real smart too. Like you're one of the best at what you do, but you only take one shot.
You're limited.
I mean, you still probably have, at least a 30% chance of failure.
Mm-hmm.
I'm just not quite getting it right. There are so many factors beyond your control,
right?
That can adversely impact you. Now, if you go through that process, for 20 different investments, then all of a sudden the odds get much better because you're applying a good process multiple times.
Yeah, and I think that the operators that we're working with, people can really trust the process that these guys have because they have a proven track record.
That's exactly it.
So on the institutional side, sort of, what are you hearing from your clients there? I know, you work with a lot of these big institutional people.
It's still pretty early. You can go look at the real-time transaction flow, and there hasn't been a whole heck of a lot. I think that in the opening stage, everyone was just focused on portfolio triage. And now they're starting to, think more and more and look at more deals. I think that if you talk to most investors, they do still have this long-term perspective where, they know the kinds of growth characteristics that create value in a market. And
so what are those sort of growth characteristics that you think they see just for our investors' benefit?
I mean, it's, if you're talking from, an office perspective, it's really about, and I mean, this goes out to multifamily and down to retail. It's all about where you have high income industries growing and concentrating, because those are the people that are going to be driving, the best knowledge sector businesses. And I mean, and I think, in a lot of cases you end up with cities that are very expensive to live in. But, those reach a point where you start to have demand leakages into areas that have those other benefits, cost of living, the ability for people who are, well remunerated to buy, to buy a house.
Yeah.
So, I mean, there's a steady flow of bodies into a lot of these Sunbelt markets for that reason. And as those people come, they've been, built and built up the amenities in those markets,
Yeah, I think that's really interesting. So segue to some of my last couple questions, and I'm put you on the spot a little bit here. So over the next 12 months, who do you think are going to be, both property type and market, sort of the two biggest winners?
I mean, industrial just stands out pretty easily. I'm not really taking much of a risk there to say that during a time where everybody needs to have everything delivered, that the businesses and properties that do that are going to do better.
Yeah, so you think Amazon will do pretty well over the next 12 months, I take it then?
I think they're going to be fine. They're going to be fine, and I can tell you that if you go out there with an Amazon tenant industrial deal,
we did, and it flew.
Yeah, not going to have a problem.
That, and then any other second? How about another property type that you think is poised to do well over the next 12 months?
I mean, the other slam dunk, of course, so far has been data center. I mean, hell, you go look at data center REITs; they're up, 20% year to date.
Mm-hmm. What two markets do you see, either gateway or secondary market, that you think two markets that you think are poised to have a good resurgence?
I mean, I think that it's tricky to say this right now with Florida and Arizona and Texas
getting on the chin.
Yeah, getting it on the chin. But I do think from some, there's some fundamental basis that suggests that they are overall better exposed to recovering quicker.
Okay.
This time around, and that just gets back to them being flatter cities.
Yeah.
Where people drive. Public transit dependency is going to be a problem with a capital P. Over the next year.
I mean, even internally, we were, we put out a survey seeing if people were comfortable going back to the office. And the biggest thing people said is, hey, I'm fine to go back to an office. I don't want to take the train every day.
Yeah.
And in New York City, there's nowhere we can have an office where, 50% of our team doesn't need to take the train every day.
Exactly. I mean, that's, another thing I'd even layer on top of that is if you're thinking about work from home, as the opportunity cost, right?
Mm-hmm.
You need to limit the opportunity cost of going into the office. And part of that is this, if you're looking at talking about, okay, I could work from home where, right now most of my colleagues are doing too.
Mm-hmm.
Or I could go into the office, and let's even say I don't need to use public transit, and I'm going to spend 2 hours of my day doing that. People are going to do a rational calculus. So if offices or markets in general that offer lower commute times are probably going to be a lot quicker to get back to the point where it makes sense to go into the office. I mean, another way of putting it is that every office, every company, every individual is going to face this decision of when is there a threshold of people back in my office where the magic starts to happen again.
Yeah.
Because there is a magic that can happen in a well-run office. That's why we do it.
Yeah, no doubt about that.
And that's why we're going to continue to do it. That doesn't happen with 25% occupancy.
Yeah, or some of your team filing in one day and some of the team filing in another day.
Exactly. You need to create enough of that buzz within your working unit where it makes sense. You need to be able to do face-to-face, and that's going to happen more quickly in markets that don't rely on public transit as much and have relatively acceptable commute times.
Yeah, I think that's a great point and really interesting. So last question for you before we jump. I just want you to give us your wild card, your surprise winner, in terms of market and or property that you see next 12, 24 months.
Surprise one.
Something that, you don't think other people are sort of clued into right now.
I'm so tempted to just say New York because, no one's calling it. And I think there's so much bearish sentiment out there.
Mm-hmm.
I don't know whether that's the 24 months, but there's some vagaries around that.
Mm-hmm.
But, look, I was reading an article the other day with, where a very, very smart, very successful investor thought that, said that he thought, office values in New York are going to be off by 40%. If that's like, a view, and I mean, you go look at some of the REITs and they seem to be in line with that. I don't believe that for a second. I don't believe that that's going to be the case. I think that is wildly pessimistic.
Interesting. Yeah. I mean, I think, your initial reaction just to how hard New York City was hit, I think everyone's reaction was, "Oh, they're never going to recover from this."
Yeah, and I think that's a load of phooey. New York is a magical place, a dirty but magical place.
I'm born and bred here, so I have to say I do agree with the magical, and unfortunately, I agree with the dirty. Our trash collection has gone downhill.
I'm a recovering Manhattanite myself, but it's an incredible city. There's there's almost nothing like it in the world. And nothing's been able to beat New York yet. And this isn't going to be the one that does it.
Yeah, and I love to hear that. That's I think for me, and I think a bunch of New Yorkers, that's kind of what we need to hear right now. So thank you again for joining, and hope maybe we could do this again, maybe 12 months down the line, or maybe before, and see if some of your predictions hold out to be true.
Look forward to talking to you guys soon, guys.
Yeah, man. Thanks.
Once again, that was David Bitner with EquityMultiple's Director of Finance and Operations, Clay McMickens. Clay, thanks so much for bringing this conversation to us.
Yeah, of course. It was a good time, and it was an opportunity for me to learn myself.
Again, thanks for sharing the conversation and introducing us to David and his work. Any last words before we sign off?
So yeah, I just wanted to thank David Bitner for joining us, and I encourage all of our listeners to check out some of his research work. As I said, he's sort of the best in class for understanding macroeconomic trends, real estate fundamentals, and any dynamics happening in the capital markets space.
If you want to learn more about Mr. Bitner's work, or if you want to reach out to Clay or myself, as always, we've got links in the show notes. For Equity Multiple, I'm David Lofgren. See you next time.